Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week, we certainly had a bit of a turn of events with regards to a shift in terms of overall momentum to the equity markets. For the past nearly 6 months, we've been very much straight and up to the right in terms of positive momentum, in terms of equities continuing to grind higher. Over the past couple of weeks, we really have seen that the equity markets have failed to make new highs. So the momentum is clearly decelerating. Now, here's the thing is that after 6 months of strong positive momentum, it is healthy for markets to have consolidation, even pullbacks, before they can continue moving higher. It's actually unhealthy for markets just to continue move higher like this that we've seen here over the past 6 months or so. So we certainly welcome a bit of a consolidation, potentially even a bit of a pullback for assets that perhaps got a little overinflated to correct a little bit and then potentially uh, present itself as another buying opportunity for equities. Now, are we in a correction? Is this going to be a buying opportunity? That's yet to be seen, but we certainly have seen a slowdown in terms of the pace at which equity markets continue to move higher. We certainly have seen an uptick in terms of um, concern from markets, and those are some of the charts we'll look at here for today. But the S&P 500 last week, basically trading flat for the week. The Nasdaq 100, same thing, but nearly for 2 months now, the Nasdaq 100 has not moved higher, and this is the first quarter we've seen the Nasdaq 100 underperformed the S&P 500 in quite some time. As you can see, the relative performance since the beginning of the year is actually slightly lower. Um, Typically, the Nasdaq 100 outperforms the S&P 500. This was in Q1. We actually saw the Nasdaq 100 underperform the S&P 500, just kind of showing you how weak the leading growth tech names have been in Q1 and to the start of Q2, similar type of price action as well. You look at IWM, small cap, same type of scenario. Small cap underperformed the S&P 500, and over the past 4 or 5 weeks, we really have seen, the small caps make no progress on an absolute basis, and on a relative basis starting to underperform the S&P 500 as well. We started to see a little bit of outperformance towards the beginning of February into March, but that has kind of started to reverse back lower here. So small caps played a bit of catch up, but so far no longer kind of outperforming the S&P 500. And even the equal weight S&P 500 started to, we were starting to see some um, improvements in terms of broadening out of this overall rally. But over the past few weeks, we really have also seen that stall a little bit here as well. So those are some of the concerns that we currently have with the overall market. If we look at growth versus value names, we continue to see growth underperform value here at the moment. Now, it's not by much, but a little bit we've seen growth outperform value. And this is despite the fact that growth has outperformed value by a pretty substantial margin in the long run. But over the past nearly 2.5 months now, it's been consistently underperforming value. So this is really kind of the slowdown we've seen with equities, is because growth names is these are the mega cap tech names that are no longer dragging the markets higher. These are kind of some of the risks that we see here with the overall market. We have seen commodities break out here. We've talked about commodity, the breakout here, a bit of consolidation, and now it's moved even higher here, just shy of the recent highs around 23 on GSG, which is the iShares commodity ETF. And right now, what we're looking for is perhaps a little bit of consolidation, a little bit of pullback, and see if we can break out here above 23. Things at the moment still look fairly constructive overall for commodities such as gold and silver. So our expectation is that commodities still potentially has upside despite the fact that it's fairly overbought in the short run. If we look at high yield bonds, we've talked about the fact that high yield bonds have consolidated after what has been a long period of outperformance, a long period of consolidation, and we've gotten the breakout. But that breakout so far has not seen any follow through. It's actually started to fail a little bit here. So this is kind of what we're paying attention to right now as to a bit of a shift from the bond markets to a risk-off tone, and we'll take a look at some of the other other indicators here from bonds. But so far bonds have not signaled a very strong risk-on environment at the moment that we're looking at. Now, the VIX last week was the big mover here. We got into the 16.5 handle on, I think, Friday of last week, or I'm sorry, Thursday of last week. We have retreated back to about the 15 vol on the VIX, looking out 30 days. So clearly we've seen a pretty significant uptick in terms of what traders have to pay in order to buy protection over the next 30 days, really speaking to the fact that there's a bit of angst in the overall market, as we kind of slow down in terms of positive momentum. There's certainly been an increase in put buying, and that's bid up the prices of puts. So, investors perhaps having the sentiment looking a little bit more bearish here starting off this week. 10-year yields, still trading just shy of that 4.4%, really speaking to kind of the bond market shift, right? We've seen sort of since the beginning of the year, bond yields rising from 3.8 to 4.4 now. So a pretty substantial shift in terms of bond market expectations for rate cuts this year. Right now, bond market's playing a little bit of chicken with the Fed, but certainly bond prices is starting to show that expectations for 3 rate cuts this year may seem a little bit aggressive or optimistic. I think, we may see, especially with the CPI print this week, that we continue to see bond yields change expectations for the number of rate cuts this particular year. TLT, long-term bonds, starting to break below this $92 support level, 91.5 support level. This is one to pay attention to because this break really starts to put long-term bonds back into the mid 80s in terms of the next support level here to the downside. That would be a pretty significant risk-off signal that we would be getting if we do see TLT break below these major support levels. So bonds, like I said, overall shift in tone over the past week and starting to show that there's a bit more of a risk off tone that we've seen. The dollar index remains range bound between this 102.5 and 105 range. We hit the top end of the range last week. Expectation is potentially for dollar to kind of decline down to the 102 range. So fairly range bound, not a big expectation in terms of dollar index for currencies. Gold continues to make an all-time highs. We talked about the breakout here above 2150. The breakout here consolidated, tested it as support, and has really taken off here. Gold in the short run remains overbought, but this is a long-term setup here for a big breakout here for gold. So despite the fact that things are overbought, my expectation is that we will likely in the next few weeks continue to see upside in gold, especially on this kind of risk-off environment that we're currently in. Oil, the breakout here above that $79 level continues to look constructive here for oil. The next upside resistance here is around $90 to the upside. That's our short-term immediate target for oil. Currently, we're trading at around 86.5 at the moment. So another $3.50 to the upside with regards to potential upside for oil. And that's a benefit to energy. We'll take a look at that in a couple of minutes with regards to the sectors. So when we look at the overall sectors, some of the ones that I think are worth paying attention to here right now, technology is obviously one because, technology is what led this rally, but over the past nearly 2.5 months, technology has made no progress. And what you have seen is that relative chart right below the absolute chart shows you the relative performance to the S&P 500. So technology continues to underperform the S&P 500, and you see momentum continuing to decelerate. Still positive at the moment, but decelerating and starting to turn negative here. which is an overall risk for the markets. As you can see, XLK, the technology ETF, flirting with the 50-day moving average. This is one that we're paying attention to. A break below that 50-day moving average could bring further downside here for technology and the overall equity markets. But one of the big ones that I really want to pay attention to is consumer discretionary. Consumer discretionary since the end of last year has underperformed the S&P 500 by, at this point, about 8% here. Consumer discretionary and tech are the two biggest sectors and two arguably leading sectors of the markets. And over the past 3 months or so has really underperformed the markets. And this is a concern for me in terms of looking at the equity markets as to what's leading the markets higher. Technology and discretionaries are nowhere to be found. And the question is whether they're just consolidating and we're seeing a bit of rotation and they'll come back to performing, or if this is, the start of a longer term underperformance because of those sectors being fairly overvalued from a valuation perspective. So those are the things that are really important to pay attention to from a fundamental perspective. Financials continues to outperform. We have banks reporting earnings later this week. Very interesting to see that financials continuing to outperform the S&P 500. That certainly bodes fairly well for bank stock earnings later this particular week. Healthcare, this is one that is continuing to fall apart here. Healthcare has broken that 50-day moving average. We've come back to kind of retest that as resistance, and so far starting to trade lower here. And if you see that relative performance, incredibly poor. We've seen momentum turn negative here for healthcare. So this is one that I'm looking for potential downside here. The next target here to the downside is around 137 on XLV. On the flip side, materials looks incredibly strong and remains strong, continues to outperform the S&P 500 over the past 2.5 months or so. Momentum is starting to slow down here. You see higher highs in price, no longer being momentum in the short run. That adds the risk of a short-term pullback here for materials. You see the same type of evidence on industrials, higher high in price, outperforming the S&P 500, but higher highs in price no longer being confirmed by higher highs in momentum, which leads us to a higher probability of a short-term pullback, perhaps into that 120 level here to the upside. So, short-term positioning across the board in terms of equities, even in the strongest sectors, don't look that strong, with the exception of energy. Energy is probably the one exception. Higher highs in price being confirmed by momentum with positive outperformance. This is a sector that we expect will likely continue to outperform here, especially as oil potentially hits that $90 level and potentially higher even above that. So energy overbought by all means, but in the short run, actually showing a fair amount of outperformance. And I think that there's more upside. So a few more names to kind of pay attention to here, looking at ARK. Really what we're paying attention to are the strongest names that have led this market higher, growth names. Are they starting to show some weakness here? ARK so far has managed to hold this kind of $47 support level, but as you can see, it continues to make lower highs. So the question here is whether or not this kind of potentially breaks lower here. If you look at the relative performance, it looks poor. Momentum has turned negative. This leads me to believe that there is a risk that this type of growth name might start to pull back here. You also see the same thing here in some of the other high growth sectors like biotech. Biotech, IBB, ETF, however you want to draw your lines, starting to look like it's breaking that major support level around 133 or so. So far, potentially moving lower, as you can see, the underperformance, the negative momentum here, all leading me to believe that some of the tech growth names that are leading this markets higher are starting to turn lower here. Same thing here for retail. You see the same thing for the retail ETF, XRT. However you want to draw your lines, we've broken that trend line here, potential downside. as you can see, the underperformance is small at the moment. It's not quite as severe as ARC and biotech, but it's starting to be there, and momentum hasn't turned negative just yet. So this is one that's on watch. And then if you look at semiconductors, what you see here is semiconductors at the moment still hanging on in there. This is one that's really holding the markets higher. If this were to fail, that's really kind of where things can start falling apart here. You can draw your lines a few different ways, but so far the bullish trend line seems at the moment still holding. Relative performance is there. Momentum has slowed down significantly. But it's still positive. So it very much has the opportunity of kind of bouncing higher from here and start outperforming. And that certainly would put us back into a risk on environment. But we are very close to these trend lines that we are watching this very closely for potential break lower. If we see that break lower with relative underperformance and momentum starting to turn negative, that would be a pretty significant concern for me from the overall markets. So then looking at some individual ideas for today, BlackRock reports later this week. It's one of the financial stocks that report later this week. But one of the things I did note recently is that if you look at BlackRock, it's trading around the 790 support level. And so far on the surface, it looks like that's holding. But if you look at the relative performance, it's starting to turn a little bit negative here, and momentum has turned negative. That leads me to believe that there is the possibility that if you look at earnings for BlackRock, this could miss and break lower here. The next target here to the downside, 760. Not a big move here to the downside, but potential that's for some sizable moves. And lastly, taking a look at some of the names like Home Depot also. Home Depot, similar type outperform. Sorry, this is General Dynamics. Let's look at Home Depot. Home Depot starting to show that similar underperformance here. As you can see, broke that significant trend line, broke that underperformance, and momentum has turned negative. So overall, these are some of the things that are concerning for me with the overall markets. Pay attention to for CPI this particular week. Pay attention to the banks that are reporting earnings this week. Those are some of the things that we are keeping an eye on. So with that, thank you so much. I hope you guys have a great trading day. I'll see you guys here next week.